Goldman saying that bear market rallies are the norm. This is something we've talked about a little bit here and there, but I wanted to quote a stat here that I saw published, I think it was last week. We come off this big 9-day rally across financial markets, NASDAQ especially, but of the 25 best days ever for the NASDAQ, which included Wednesday of last week, 22 of them took place during the dot-com collapse. So I'm not talking about during the run-up of the dot-com bubble, but 22 of the best days ever for the NASDAQ occurred while the NASDAQ itself was on its way down to, what did it go down, like 80% during the dot-com bubble? 80, yeah. The 08-09 crisis or early days of COVID. So it occurred, 22 of those days occurred during that dot-com bust, 08-09 or early days of COVID. One more during the 87 Black Monday event. So the point that I am attempting to make here, and that Goldman I think makes pretty well, is that it is incredibly common for markets to rally even during recessions and bear markets. And what we experienced during March of 2020, which was, just to remind you, like a 3-week straight down. We had, I think, 3 or 4 days where markets were paused for trading because of how significant the downturns were. That is the exception rather than the rule. Very rarely do markets fall by 30% in a straight line over the course of 2 or 3 weeks. Generally speaking, when markets go down, it does have moments of steep downturns, but it tends to be defined by uncertainty, changes in what people expect are going to happen, and therefore downturns followed by rallies, followed by downturns that ultimately culminate in some bottom that is eventually found. But I think some of that whipsaw effect can be treacherous for investors, especially those that try and trade them. You go take a look at the last 15 years, we haven't had a ton of that in markets, right? Since the 08 financial crisis, there just has not been a lot of that significant drawdown in equities that plays out that way. And I just wonder how investors are navigating it today compared to previous times.
Yeah, you don't know something is a trend until well after the fact.
Right.
And it's normal to, in the midst of economic turbulence, see a little clearing patch in the sky and think, well, this could be it. The storm could be moving on.
Right.
And in reality, you're just in the eye of it. It's always obvious in retrospect, obviously.
Yeah, because it's obvious.
But when you're living, because you know how it ended. I don't really have any deep insight other than to say, volatility.
It's pretty normal.
Oh, totally normal. Yeah.
And it would be fairly normal for the markets to reach new all-time highs. It would also be fairly normal for us to move steadily downward into a recession here and see several more 10% rallies over the next few months. I have to stress that quite a bit, is that just because markets have rallied over the last 9 days and just because trade concerns have dissipated a little bit doesn't necessarily mean this is over. But likewise, everyone calling for the next recession doesn't necessarily mean it's going to happen either.
To me, the key thing is a long-term asset allocator, as we like to call ourselves when we are stewards of other people's money, and those other people tend to be long-term investors. We're asset allocating. We rely on stocks for their long-term return potential. They're tied to their growth. The growth of stock prices is tied to stock earnings, which is in turn tied to economic growth. I think a long-term asset allocator like us in our day jobs at Armstrong Advisory Group should be far more concerned about the drag on growth that could come from an unsteady trade regime and disrupted relations with our long-term trading and military partners. If we're not going to create the conditions that allowed the spectacular growth that we experienced in the latter half of the 20th century to happen, if we're going to turn our back on those conditions, we can probably expect lower growth, more volatile growth, and all else equal, that translates into lower returns from stocks. So as a long-term asset allocator, I'm far more worried about what our institutions are going to look like coming out of this than the day-to-day.